So, can we play? Can we hit play? Do I have to do that, John?
No, I can do that.
All right, hit it up. Hit it.
Want to play it right now?
I got
Yeah,
it. 1 second.
John, I'm proud of you.
That's why we're going off the charts with help of Joe Fahmy. He's the portfolio manager at Zor Capital, LLC. He's also the founder of JoeFahmy.com education because he's got a unique take on this situation. When you look back, we've had a bull market in all things AI going back to late 2022, early 2023. You can argue about the exact start date, but certainly by May 2023, the AI revolution was upon us. I'm grateful. Because that's when NVIDIA, the backbone of artificial intelligence, delivered one of the greatest earnings report I've ever seen. And aside from a detour earlier this year, the stocks never really looked back. We know that in terms of money-making potential, AI is more of an enterprise technology than a consumer technology. But Fahmy points out that ChatGPT was still the fastest application to reach 100 million users.
So this was
we don't need to do the podcast if you play this whole thing.
So did you notice that he went from Fahmy to Fahmy and back and forth?
Fahmy 4 different ways.
Yeah.
Fahmy,
Fippy, Flappy, Samsonite,
Fudgy, everything. It was great.
Dude, that is real shit. There's millions of people that see that.
It was beyond grateful.
Did your phone blow up?
My phone never blows up. No one calls me.
That's true.
No, I got some emails. It was good though.
When was that clip? Like
last week.
Oh, nice.
So I've never met you. Have you guys ever
Actually,
met?
no, we met because you beat me in the StockTwits award.
Oh,
Creator of the year. I was one of the nominees. I thought you were gonna do it right here, stacked in the middle.
How is my mini stand-up routine?
It was good. Did you wing it?
He beat you in what?
The StockTwits Creator of the Year. It was between me.
Well, I had Josh. It was 2-on-1. It wasn't fair.
Josh. Okay.
So
someone
I
else,
want to
too.
tell you. So we're going to see comedy tonight. I did well. I did like 30 seconds of stand up.
You did stand up?
I mean, 30 seconds. Was it good?
You did comedy?
It was good, but I mean that night was really raunchy. The comedy.
My routine was a little racy. It was a little.
It fit the theme.
Thank you.
That's the thing. It did fit the theme.
That's awesome.
So
would you ever do open mic?
No.
Really?
No. I did 30 seconds.
I've been dying to do that. But I'd go.
I'll tell you.
Could you do 5 to 10 minutes of stand up?
I think I could.
You could tell stories.
I think I could.
Yeah.
I think I could.
You could make it funny.
All right, so I am very excited for this. Josh is probably, what time is it in Italy? He's probably drunk on Cavatelli right now.
So jealous.
9? Yeah, he's definitely drunk on Cavatelli. So you guys...
is this mine here or is that his?
That's yours.
Okay.
You know what?
The cord was going
Are we
across
clickety
his legs.
clacketing? Are we ready or not yet?
If you're ready.
Yeah, let's go.
Ready.
Let's go.
Let's just get the headphones on and get
Let's
going.
go.
Do we do a sound check? Or?
No, we're good. Joe, you always raw dog it with us. No computer.
Why do I need a computer? This is my computer.
USA. USA.
All right, 3
Thank you,
drops
guys.
coming in.
Let's go.
Do I have to smile again?
Yes. Pretend like we're friends.
Pretend like we're friends.
98.
Today's show is brought to you by our sponsors at Betterment Advisor Solutions. If you happen to be thinking, there's got to be a better way to grow my RIA, you're not alone. With Betterment Advisor Solutions, we do the heavy lifting so you can focus on what matters most, your clients. From improved service that makes asset transition smoother to fast, paper-free onboarding that delights clients on day one, we've built a digital-first platform designed to streamline your operations and make life easier. Now, if you're thinking, wow, they take the paper out of paperwork, then you'd be right. Grow your RIA your way with Betterment Advisor Solutions. Learn more at betterment.com/advisors. Investing involves risk. Performance not guaranteed. 198?
198.
Okay.
198. Wow. It's like Billy Joel, Madison Square Garden.
My fiance wasn't even born then.
You have a tag on your shirt.
Good. It's there for... Oh, this is not there for a reason. Where's the music? Let's go. All right. I am... Personal order. This is a personal order. I'm very excited to be joined by my good friend, Joe Fahmy, and my new friend, Shay Boloor. Everybody here knows Joe, but for new listeners, Joe is a portfolio manager at Zor Capital, a New York-based investment advisory firm. Joe has 127 years of trading and research experience and has appeared on CNBC, Yahoo Finance, Wall Street Weekly, and more. And Shay is the chief market strategist at Futurum Equities, an investor intelligence and research platform. And he's the host of the Daily Rip from our good friends at StockTwits with Katy Perry and Bruni. Shout out to all the people at StockTwits. For those of you who don't know what StockTwits is, it's a social media platform for traders and investors. Gentlemen, welcome.
Thanks for having us.
Thanks for having it.
So I appreciate you guys being here. It is the third, and also Daniel, Duncan, Nicole,
Your crew's
John.
your crew's
This
awesome.
is, they are not happy to be here. It is Thursday afternoon.
That's why they're awesome.
Before July 4th, they're like, Josh is off. Are you f***ing kidding me? We're really doing a show. We're doing a show.
Damn right.
The audience shows up for us, so we show up for them. I'm excited to have both of you on today because there is a lot of overlap in the pond that you fish in. Joe, I know you're a big eater.
It's a big pond.
So you both are invested or interested in growth stocks.
Yep.
You particularly hyper growth stocks, but you come at this from a very different perspective. So I am excited to get your guys' views. Thank you very much for being here.
Thanks for having us.
no
This is
worries.
exciting.
I will say I feel like a little substitute teacher during fifth period before summer break, but it's all
come
good.
on.
It's all good.
Okay.
It's all good.
We could be the Tom Brady, the 6th round pick
Ooh, I
before
love that.
the holiday weekend that no one expected to be. Anyways,
So okay, let's talk about the bull market. Joe, you wrote a research note. We just alluded to it. Kramer took some of your stuff. I
Yeah.
know that you take a longer view, a shorter view. You're very aware of the fact that there are risks and the market doesn't go straight up, but you like to zoom out and not get shaken out by all of the wiggles and gyrations of the market.
I try.
Where do you think we are in the cycle?
I'm saying we're about year 2 of a 4 to 5 year bull market. That's where I think we are. So the reason I titled the piece, "Don't Lose Track of the Bigger Picture," because I believe we started a new bull market in late 22, early 23. I say May of 23, and I'm saying that because it's a bull market driven by AI, and that's when NVIDIA reported the greatest quarter in the history of the markets. Some people say October of 22 because that's the actual low. That's when ChatGPT came out. Who cares? It's all semantics. The whole point is late 2022, early 2023, new bull market powered by AI. Historically, I'm a market nerd, geek. I love studying history. Historically, bull markets are powered by inventions and innovations that revolutionize our lives. Go back to railroads, airlines, television, PCs, drug discoveries, the internet. You get the point. The new discovery or the new invention that's revolutionizing our lives is AI. What do all of those discoveries have in common? They help increase productivity. So railroads, you got from New York to LA a lot faster than you did walking, obviously. So you have a lot of people way smarter than me, and I know that's a huge sample size. They're saying that AI is going to be bigger than the internet. It's going to help increase productivity. Mark Andreessen's a perfect example. Go look at his piece he wrote a couple years ago called "Why AI Will Change the World." You have a lot of people saying that, and I'm saying that's when the AI, which has been around for a while, but where it really started to pick up in early 2023 with NVIDIA, the true market AI leader. And my whole point of the piece is that this is going to go on for a while, very similar to the 95 to 99 period. However, there's a huge, huge factor in this. There will be corrections, shakeouts, pullbacks.
Just had one.
And you could argue the recent tariff one was an example of one.
Yeah. Shay, you, I think you are newer to investing than Joe is.
I'm older than him.
How do you view, so I know that you have a very unique style. You are probably less concerned with a lot of the broader, where are we in the cycle, interest rates, who cares? You are focused on companies that are absolutely changing the world. So do you care about where we are in the proverbial cycle?
No, because first off, history doesn't rhyme, but often repeats, like going off of what Joe's saying about the dot-com era. If you go back in history during that revolution, what was the hidden gems of that era? It wasn't the IBMs, the Verizon, AT&T, these firms that are building the structural arteries of the internet. But the first phase, it felt like these are going to be the biggest companies in the world. The hidden gems of that era were the online marketplaces that were built on top of them, the Googles, the Amazons. So right now, it's still in that first stage of AI. All the attention is on the Mag 7, the NVIDIAs of there, the hardware, servers, compute, etc. The biggest winners of this era won't be those names. Although NVIDIA, it's hard to say they're not the biggest winners. Going from about 200 million to 4 trillion is wild. But you're getting signs of like what the second stage of AI winners are going to look like and how explosive it's going to be, because we have Palantir. Palantir is the first company that proved if you build on top of all this AI hardware, how disruptive it could be on so many different industries. So right now, Palantir, I got in very early, a couple of years ago. I saw the vision of like, I think they're going to be the stage 2A winner. First one, there's going to be multiple. Now a $300 billion company, but there's going to be a couple of them. So when we got this pullback recently in Q2 of this year, I'm like, I was laughing because the way AI investment works, when they spend billions of dollars, you can't just turn the switch off and then pause until this tariff war resolve itself. Like this business spending paralysis we experienced, it wasn't going to be terminal because AI investing does not work that way. It was going to have to continue, or all the costs that you did originally was going to be sunk. That's not the way that enterprises work. So I think that Q2 was a gift because we're still on the path towards that second wave of AI, which hasn't really happened yet. I believe that as soon as agentic AI has its ChatGPT moment, that's when we're going to see multiple stage 2 AI winners, not just the Palantirs, Cloudflares, et cetera. There's going to be a lot more companies that are going to be going from small mid-cap to all of a sudden they're a mega-cap company.
All right, so Joe, Bespoke has been on this beat for a while, showing ChatGPT, the launch of ChatGPT in November of 2022, overlaying that with Netscape. And whatever, 2 lines, magic up, who cares? But they do track, they're both going up and to the right. And it sets the stage that maybe we are not necessarily in the 8th or 9th inning of this bull market. It is a little bit hard for investors, myself included, to think that we are in like the early innings of a new bull market, because I think that people think we've compounded, the S&P has compounded at 15% for like the better part of the last 13, 15 years. You're telling me that like we're now just experiencing a leg up? How?
Couple of things. One thing I've learned from 127 years of doing this is moves go on in the markets way longer than we can expect. So just when you think something can't go higher, it usually does. And just when you think something can't go lower, it usually does. So moves can go on longer than we expect. I'll tell you a really quick story. I have a friend of mine who was a famous hedge fund manager when CMGI, the internet incubator in the 90s, it went from split adjusted 1 to 120. And he said, this is a zero. This is my biggest short position. This is a zero. And he was dead right. You know what the problem was? It went to 360, split adjusted before it went to zero. So that's an example of moves can go on much longer than we can expect. The second thing I was going to say is that we just came off of 2 bear markets from COVID and in 2020 and 2022. So when you're saying like this is
3
just
3 bear markets. What do you call the first quarter? Or April?
Technically, yeah. I think it was bear market like. I know you're going by the stupid
Dude,
20%.
NVIDIA fell 35%.
Yeah.
It was a quick bear market. It was a bear market.
Yeah, I think the tariff scare was kind of a bear market, just quicker. Average bear market's about 9 months, 27%, but that's average, sometimes shorter, sometimes longer. But you had COVID, you had 2022 when the Fed was raising rates, and then this tariff scare. So when you're saying like we're just getting started, we've come off of like 3 really huge corrections in the past 4 years.
Yeah, we lose sight of that very often when you look at the returns. It's like, well, they were hard. They were hard. It wasn't just straight up into the right. So, Shay, I should have asked you this earlier. Before we get too deep into the conversation, who the hell are you? I see you on the internet, on Twitter. You're doing great things. You're going deep in these companies. But where did you come from? What is your background?
What are you doing here?
Yeah, seriously. Well, how'd you get on the show?
I feel like I just went on a reality dating show and it just got popular all of a sudden. No, because my buddy actually hit me up this week. He's like, last time I talked to you, you were working corporate strategy as a director. Now you're on TV 6 times a week. So essentially, I started as a corporate strategy director at a Fortune 10 company, and my whole career has been digesting large sets of data and creating a narrative for C-suite because they don't have the time to do exactly what needs to be done. So my interest has always been in investing. I did it on the side. 2020 happened. I became a FinTwit follower. I was like, I don't like legacy media anymore. I think this is much more alpha and it's much more exciting. And you saw the explosive nature of 2020, 2021. It's like, I got hooked. And then I started using all my skill sets I learned in the W2 world into my investing. And I was like, I think there's a niche on FinTwit, for example, of something I can offer. It's usually data vomit or too much noise, not enough signal. So I was like, I'll try it out. And especially my girlfriend at the time, fiance now, she was sick of me talking about it. I was like, that's a good outlet. Maybe I'll try it out. And that was 2 years ago. Now it's turned into all this. I'm now
you were talking to your fiance about stocks. I'm sure you love that.
Of course.
She stuck around.
She's an artist too. Think about that.
Yeah, that sounds awesome for her. So what's Futurum? You just started this.
Yeah. So Futurum is essentially, there is exactly what Robinhood was doing for brokerages, taking down that wall, democratizing how to invest. There still has not been done that for the research side. Institutional research, there is a massive paywall on that. And there's a reason for it. It's because they're closer to the access, closer to the signal of decision makers. They want to maintain that kind of defensible moat. Futurum has a B2B angle, and Daniel Newman, the CEO and founder of Futurum, he knows the next derivative of institutional research has to be retail. So he's willing to take that risk of being the first to disrupt that institutional wall and democratize research. So now you have Robinhood democratizing how to invest. Now we're trying to democratize what to know before you invest. Those two are part of the calculus, I think, is going to be pretty explosive in this era where, I don't know, JP Morgan released something recently that 60% of investors essentially are retail, and retail is becoming such a heavy component of the market where you're seeing Robinhood, they're almost $100 billion company.
Bigger than Apollo.
Insane.
Seriously.
And Palantir was almost bigger than Oracle at the time, like just 6 months ago. Like you're seeing how much weight retail has, and it's impossible to ignore.
Yeah, if you're still dismissing the retail as investors as dumb money, you're the dumb money.
No, institutions went on the sidelines April 7th. Where was the bottom?
Right.
Same week.
They puked into the lows. Yeah. And they've still slowly getting back.
And that's why there's real move on this V-shaped recovery, because there's trillions of dollars that need to be liquidated into the markets from that sideline reaction that they had 2 months ago.
So let me ask how, because you've never been through, and I wasn't alive. I mean, I wasn't an investor during the dot-com bust either, but haven't been on the other side of the excitement going the other way and the multiples going from 130 times sales down to 3. How do you think about risk when you're looking at these companies? Because I know you don't care as much about the valuations or the ratios. That's, but how do you think about downside risk?
I actually disagree. I think I experienced it in 2021. I think that bubble that we experienced, like
I agree.
That was pretty excessive. So I think that my learning lesson from that era was you have to invest in companies with a moat, a competitive advantage. Do they have a network effect? Do you have a product that's scalable? Do they have an ecosystem that locks you in? I think a lot of, like IT is a great example. A lot of software companies, it's tomato. You have to really invest in a company right now that has a defensible moat, a monopoly or a duopoly, and let the market rise 20, 25% a year and just take it with you. So I think right now, like I used to factor in fundamentals, actually part of my equation of being an investor, which companies to invest in. Now I'm like, I want to pick the companies that have a monopoly and early secular growth themes with plenty of runway. Nobody knows the ceiling on AI yet. All they know is it's going to be impactful. And going back of what Joe's saying, every revolution, it's been product oriented in my opinion. AI isn't a product. It's a characteristic. It's providing intelligence. And because it's not a product, it's a characteristic of what the world's going to become. That's highly scalable across every industry. Everything you do will be touched by AI going forward. You can't say that about really .com era. Maybe you could because everything's website, but not really. There's still brick and mortars out there. You can't say that about the cloud era. So this is the first of its kind, in my opinion, where scalability of it is unmatched. It's never been done before.
So on the fundamental side, for Amazon, as an example, in the aughts, when they were hemorrhaging money, net income was clearly the wrong metric to look at. Yeah. It was free cash flow.
Yeah.
And that opened people's eyes into how to maybe think differently about these hyper growth stocks. What do you think is the new sort of metric for these AI companies that are rewriting the laws, the fundamentals of business? Do you think that there are new metrics, not to sound like so poppy, oh my God, but are there other things that we should be thinking about outside the traditional business valuation metrics?
It's a good question. You like eyeballs in the late 90s? I mean, you're right. I mean, Amazon was cash flow positive in 2003. Everyone was shorting and saying they're not making money. They're not making money. They were just reinvesting, right. So metrics, I don't know. I like to use a lot of technicals because I think if you know areas where the institutions are going to support the markets, then I figured they have the teams and the resources, that really where they've done their due diligence and their, the fundamental work where they can see where this could go 3, 5, 10 years from now. So I kind of want to follow what they do, but that's a really good question. If there's like something on a balance sheet or something, sometimes it's intangible. That's why the word value is not just PE. There's value in businesses. There's value in brands. So it's really hard to think of something specific besides right now. There's just a lot of explosive growth.
So Shay, I know you're not really a chart guy, are you per se?
I think you have to wear both hats at times, but
you're a business dude.
I'm a business dude. Like to go off of to answer your question, I do think for growth, there's a specific rule that I like to follow that I communicate. It's the Rule 40 score. You can combine the revenue growth plus the adjusted free cash flow margins. It's very difficult for an organization to have a 40 plus score. If you do, that means you have some kind of competitive advantage because anyone can grow 40% and lose money. It's really difficult to balance being profitable on an adjusted basis and growing top line 20%. So I think going forward, you're going to see the cannibalization of the software or growth tech space by seeing the imbalance of how many companies are going to be qualifying for the Rule of 40 score. Like it's ridiculous, but Palantir just scored an 80 plus recently. They're 2xing the terminal goal for every enterprise out there. That proves to me they have a moat. Another characteristic is CrowdStrike. CrowdStrike pre-outage were a part of the unicorn status. They had a 65 plus score. Now during the outage hangover, and they have to give some credits, is affecting the margins, but they're still qualifying. Even when they stopped the world from working for a couple hours, they still qualify. So I think the Rule of 40 score is kind of where the eyeballs need to be of, do they have an advantage? Are they going to capitalize on AI and maintain that status?
John, throw up chart 18, please. We're skipping deeper into the doc, but you keep mentioning Palantir. So Julian Klamochko tweeted a chart showing the enterprise value to next 12-month revenue multiple on one plot, and then against revenue growth. And for the most part, everything clusters around the regression line, but there's this one gigantic outlier, and that's Palantir. And so if you were to just look at some of these traditional metrics, I think you might miss a lot of the underlying story. Is that what you're saying?
Yeah, absolutely. I mean, for Palantir, for example, like I'm not giving you the green light, like buy it right now at whatever it's at, 200 times earnings. But I think
cheap.
For Palantir, though, it's all about, let's go on the business front. So you see all these multi-trillion dollars of investments towards LLMs, large language models. The only way to bring these LLMs into the real world is through Palantir. That's the only way right now. They have a kind of a monopoly in that status. So all this LLM arm race, that's why Palantir continues catching a bid, because they're making the case on why you need Palantir. Like if you're investing this much in LLMs, you're eventually going to have to adopt ontology and what Palantir's offerings are. And there is a thesis out there that they're growing 40%. There's a world they can grow 50% if, unfortunately, the way that world's heading towards, you're going to need more defense, especially on the government side. So the commercial side is booming right now. If the government side picks back up, especially with the recent NATO deal they announced just a couple months ago, Europe is going to start adopting Palantir as well. That government side of their business can really pick back up to 50%. And then at that point, it might be a Rule of 40 score of 90 plus, which has never been done in the software space. Yeah,
this is pretty lazy thinking, but I just to be curious your reaction when you think about a company like Palantir, the fact that when did it come public? It's been around for like
a couple years, like 3 or 4 years ago.
Yeah.
I think.
It's already got a bigger market cap than Coca-Cola. Now I know it's apples
you know what
and
my
oranges.
thesis is? Don't bet against the CIA. That's it. Done.
Yeah, okay. Simple enough. All right, Joe, let's get back to some of the technicals that you're looking at in the market. You brought some charts. John, throw some up, please. Let's start with the S&P 500. How do you think the market is behaving on a technical basis, Joe?
Okay, so this chart is an example of I'm trying to make a point of, everyone has different time frames. Longer term, if their analogy is the last great invention was, internet 95 to 99, if that's something we can compare it to. And I think this can be 2023 to, let's say 2027 or 2028. Let's just, whatever. We don't even know what we're going to have for dinner tonight. So let's not worry about 3 years from now. But the point is, I really want to stress this point. So everyone's like, oh, you guys are bullish and bullish and bullish. There will be corrections along the way. And this chart was the S&P in 97. There was a Japanese Asian currency crisis, and there was actually like a mini crash. That's a daily chart. And this reminds you, for when everyone says, 95 to 99, this chart and the next one in 98 is also like, this was long-term capital, Russian debt crisis and so forth, when long-term capital blew up, and it wasn't until the Fed came and put together a rescue to bail out the levered hedge fund.
That pullback doesn't look too dissimilar from the tariff
right,
crash.
But my point is, like, I remember being in eBay. I bought it at 50 and it went to 200, and it dropped like back down to, I don't know, like 20 or 30 during this time, and then it went to 300. So there was insane split adjusted and all that, but there was like insane volatility where at the time the Yahoos and all of these AOLs and all these stocks that were trading, they dropped like 30, 50% in the summer. So I'm making a point that I think bigger picture, if you're longer term, I think we're still going higher, but if you trade individual stocks, there will be insane volatility along the way.
You made the point just now about pullbacks, and I'm sorry that I said you hadn't been through it because you had. And it's a pet peeve of mine for people that pretend 22 didn't exist. So forgive me, Shay. 2021 and 2022 were brutal for growth stocks.
Right.
NVIDIA fell by 2/3.
Yeah.
Facebook fell by 2/3.
Yeah, all of them did.
Amazon,
Tesla, all of them.
not Microsoft, Amazon and Google both got cut in half. And we just pretend like that didn't happen. And guess what? Like I said, NVIDIA fell 35% in April.
Because they all came back.
Right.
So when they go from whatever, Meta goes from whatever it was, 400 to 100 back and even higher now, whatever the numbers were, you got to remember though, in the 90s, some of them did not come back. So eventually you're going to get to a point where they're not going to go out of business. They're just going to, like Intel and even Microsoft for 13 years. Like there's going to be a period where they're not going to go out of business, of course. They're just going to flatline. I just think that it's not yet.
So I agree. I fully agree with that sentiment because first off, like on the pullbacks, like the VIX hit a 50 handle. That's substantial.
That's
That's
scary.
substantial.
That's scary, yeah.
And I think the last two 50 handles are yen carry trade and the terrific hissy fit. It was man-oriented, one. The other one was pure technical. It wasn't really based on something structurally going to have changed for a couple of years. But that event that he's talking about, that multi-year, maybe 5 to 7 years of just lagging, that's going to happen once agentic AI has its ChatGPT moments.
Why do you say that?
Because IT spend is so bloated. It's been so bloated the past couple of years where every board of directors is telling the CEO, what are you doing to get ahead of AI? And it's causing the CTOs to overspend on just middleware that's not necessary. And it's been growing year after year. So as soon as agentic AI takes off, which AI agents, what that is essentially replaces what humans do on the back end of a lot of these software companies, you're going to see that 20% revenue growth that a lot of these software companies had, same with the hyperscalers, consistent growth, start getting a little lagging because of that digestive period of like replacing human labor force costs with just this one-time software of an AI agent. And now you have to figure out how else you're going to grow.
So you're saying that when these models change the world on a consumer level and we all feel it, that will probably be the time where all the gains have been harvested?
It's going to be on the enterprise level. I think consumer level won't be as impactful. I think it's going to be more of the middleware spend is going to diminish. And it's underappreciated how much software spends really lifting the market right now.
So who are some of the beneficiaries of the software spend right now? Are you talking about like companies like Salesforce and like
Salesforce? I think a lot of the CRMs, I think a lot of the DevOps are going to be the ones that are going to get affected by the AI. I call it the AI tsunami. It's coming. It's going to hit the software space hard. The ones who are going to not just survive but thrive are going to be the ones that the data infrastructure players, because data is going to explode. Like we talk about AI agents, like they're going to be working 24/7. They're going to be doing tasks that dozens of people have taken, and it's going to be constant workload. It's going to cause data to compound and compound. And beauty of data is like, I do a query today and tomorrow I have to build on top of the existing query. It only compounds and stacks onto each other. So I think that as soon as you see like, not Apple, you're seeing like Meta, for example. Like Meta is going so hard right now, or Zuckerberg is going so hard on making sure they don't lag in this AI race that he's spending $20 billion on essentially a shadow acqui-hire of Alexander Wang. The only reason he's doing that is because their training data is not where he wants it to be. Data labeling is a very big component of that. So in order to cut off the arm of OpenAI and Google, who was using Scale AI, he's just going to bring all that talent in-house and have Alexander Wang lead his super intelligence team, because he knows that when there is going to be that AI tsunami, if they're not going to be one of the leaders of that AI race, it might cause a 25% haircut. And 25% for Meta is $500 billion. So him investing $20 billion just to get the leader of his super intelligence team, or $100 million signing bonuses.
I've heard those signing bonuses are insane.
But it makes sense though, because it's a drop in the bucket of the $500 billion at risk potentially.
It's a good point. That's a really good point.
Joe, we had a Zweig bread thrust.
Yeah.
When's the last one triggered? That was April 25th.
End of April, yeah.
And that was about the bottom. And this by definition happens at bottoms, because it's when you get this extreme reading bearish to extreme reading bullish.
Pretty much, yeah.
And that has historically been the bottom. Dietrich has his table, I don't know, 17 out of 17 times it's been higher a year later.
And people can go to Investopedia or just Google what a Zweig breadth thrust is. It's basically...
It's when you have the 10-day EMA
yeah.
of New York Stock Exchange advanced decline, move from below 0.4 to above zero. The momentum doesn't matter. It's when you go from extremely oversold to extremely
insane
overbought.
institutional buying in 10 days, basically. And why it's so Marty Zweig came up with this, and I love his two best rules: don't fight the Fed, don't fight the tape. Legendary investor, and he came up with this. It's only happened 19 times since World War II, so that's a rare time. And what's nothing, of course, is guaranteed, but you can see going out 6 months, 12 months later, it's 19 for 19 or whatever, 18 for 18, whatever the numbers are, of being positive, and most of the time outsized returns, maybe even more than double what the average of the market is. So something to keep in mind. It triggered end of
April.
Yeah, basically from that April 9th, 10th low. Yeah, it's 10 trading days.
So check this out. I've got a companion chart. Let's throw up chart 6 from ChartKit. So Matt made this chart showing the rolling 59 trading day. Why 59? Because that's when the bottom happened. That's when the bottom happened in April. And since then, basically around when the breadth rush triggered, the S&P is up 26%. And it's pretty rare that you've had this sort of 26% change in 59-day period. Not a huge sample set, but the last 5 times it's happened, we've been higher. We've been higher 12 months later.
Right. And that's the whole point is, so again, that's kind of the theme of don't lose sight of the bigger picture. And that's part of the other reason I did this is because, you have noise with the tariffs. You have noise with geopolitical. You have noise with the Fed, all of the stuff. And I remember somebody telling me after just a couple weekends ago, U.S. bombs Iran. Oh my God, we're going to crash. We're going to zero. Everyone's going to die, blah, blah, blah. And I'm not putting that, that's not the point. I'm talking from a market analysis point of view. The market was super healthy. There's no distribution, meaning very little days of selling. That's why I'm saying there's something bigger going on here, which is the theme of AI. And I told you, people way smarter than me are like, this is going to be bigger than the internet. He understands this way better than I do. I'm just saying, don't fight the tape. There's something bigger going on here.
So let me ask you this. Sorry, Shay, just hold on. I just want to finish on this part. So in a market like this, where God bless America, we close today at all-time highs.
Yeah.
It is very difficult to ride a bull market.
Yeah.
Whether you're in indexes or even more so in individual stocks, you're not afraid.
No.
I'm guessing that you are not long right now.
No, I'm fully invested, but I've been piecing out. I'm like not fully, but I actively manage. So I do take some profits along the way.
But new highs don't scare you is what I'm saying.
No. There's stocks I would buy today. Yeah.
It's technically very bullish, new highs.
Yeah.
But
what could be more bullish?
But going off of the point of the durability of this bull market, though, if you told me entering this year that U.S. or Trump would be able to attack Iran, the market wouldn't tank, oil wouldn't spike, I'd be like, you're delusional. There's no way. That would be the closest thing we have to World War III. Why didn't we get there? It's because AI is still the main event. You're seeing these big tech companies throw billions of dollars. At Futurum, we believe the next couple of years is going to be multi-trillion dollars of spend in AI. That provides a very high floor on any kind of pullback in the market, because right now, you probably know this, I don't, but I think S&P is trading at 25 times earnings. So it's not ridiculous.
It's not ridiculous. We just had, this is from Liz Ann Saunders, Q2 saw the widest outperformance for growth over value dating back to the mid-90s. Growth was up 19% versus just 2.5% for the S&P 500 value. So just a remarkable run here. No?
No, it makes sense though, because again, you guys might be very correct me on this, but it's the first time in stock market history we have multiple super cycles happening at the same time. We have AI, we have quantum, we have robotics, electrification. This is the golden era of innovation where you have so many different themes that are going to be so disruptive in society. Why go for the value? This is an era where you're going to find early disruptors that they might miss. 90% might miss, but that 10% will be life-changing. And
historically, the greatest stock winners throughout history trade at 1.7, 1.8 times the S&P multiple, meaning the biggest winners throughout history will trade. So if the S&P is trading at 20 to 25, say round it up to 2, it's going to be 40 to 50 times earnings. And people might say that's ridiculous, but what's one of the most loved, widely held stocks in the world is Apple. And not that long ago, Apple was trading at 72 times earnings before it went up 3,000%. My point is, you get what you pay for. Big winners trade at a higher PE historically, and then they grow into that PE.
Pay up for quality.
Yeah, no doubt. So one of the things that I think older experienced investors tend to do is over-index too much on their formative years. And I think the dot-com boom and bust is like the poster child for this. So people would say, I've seen this movie before. We know how this ends. We saw the tech boom and bust. And listen, I'd say there's a decent chance that we are going to experience a bubble and a burst. I think that's probably table stakes, right?
Yeah,
that's got to be.
I'm agreeing with that.
Yeah.
I'm just saying not yet.
Yeah.
2028 is where I think is going to be like a weird
Okay,
trend.
so 28, nobody knows when it's going to come. Maybe it's here today, who knows? But the point is, for a revolutionary technology, how could there not be a bubble? Of course there's going to be.
There always is. The railroads had one, .com, and this is supposed to be bigger than all of it.
Yeah, so there will be a bubble. One thing that is different about this one, not to say that it won't end poorly, because they all do eventually, is that the biggest, deepest pocketed investors are now supporting this cycle. I'm talking about Amazon and Microsoft and Meta, who have an unlimited appetite for spend here on their R&D and their CapEx, because they think that this is an existential threat.
Right after that Zweig breadth thrust, and we were still below the 200-day on the S&P and the NASDAQ, we gapped above that on exactly, because there's going to be growth scares and people worried about spend slowing and all that. But what happened at the end of April after the close, Microsoft and Meta, when everyone's like, we were waiting to see their spend, and they're like, yeah, screw you guys. They came over the top and said, we are spending an insane amount on AI. And that's what gapped us above the 200-day, because people are like, oh, there isn't the growth scare here. No. These guys are full steam ahead.
That fear is always from Rand, though. Like the DeepSeek news, I forgot when that occurred, but that caused every tech semiconductor stock to tank because everyone's worried about, like, I want to hold in this bubble. But
I think NVIDIA was down 11% that day.
Yeah, because no one is ever going to buy their chips anymore. Hashtag sarcasm.
It's ridiculous.
But there'll be bumps along the way and growth scares.
Digestion periods.
Of course, no doubt.
That's why I'm making a point when people are like, oh, these guys are way too bullish. Yes, we're bullish, but I'm telling you, whether it's, again, DeepSeek or one-off news or tariffs, there might be even the whole point of the Zweig breadth thrust is it's 6 to 12 months now. So traditionally, August and September are two of the statistically worst months of the year. People go away, sell some stuff, and the market's a little bit weaker. We could have more tariff talks. We could have a fight with the Fed and all this stuff. But I think if we do get that drop, we got it the last 2 years, I think that's a viable dip.
This notion that we're bullish or you're bullish, this is not us. The market is bullish.
The market's telling me.
The market is at an all-time high. If your inclination is to be scared at an all-time high, you are not going to make money.
At the end of the day, the big institutions control the markets. Period. End of sentence. My opinion, your opinion, anyone's, it doesn't matter. The big institutions, the big pension funds, mutual funds, hedge funds, they are buying and or selling, but they are trafficking in millions and millions and millions of shares. So what I try to do is do my best to interpret. When they are all dumping at the end of 2021, early 2022, when the Fed raised 500 basis points in a year, they've never done that in the history of the markets, they're all dumping ahead of that, but they don't do it in one day. They were consistently doing it all through January of 2022. When they're coming back in consistently, and some of them are underinvested, where you get these tariff headlines, you get these, geopolitical headlines, they're like, we got to get involved. So when they're consistently buying and supporting the markets, that's what's telling me to stay bullish, not my opinion.
Last thing on some broader market stuff before we really dive into some companies, which I'm excited to do. Eric Soda posted this, I think this was June 29th. So last week, he said, the surprise to me is that with the NASDAQ at a new high, only 10% of the index's stocks are at a new 52-week high. They have a lot of room to run. So, Joe, I know you pay a lot of attention to internals and rotation.
Yeah.
And just on Tuesday, we saw a very unusual, wildly outperformance day of the equal weight, which was up 1.2% while the S&P was down. This is the type of thing that you love to see in a bull market. It is not narrow at all.
Sector rotation is the hallmark of a bull market, whatever that phrase is. Beginning of the month, beginning of the quarter, beginning of the fiscal year for certain, government companies, whatever. So one day there was a lot of growth stocks. Even ARKK was down 2% and the Russell was up over 1%. What I like is that it's not universally selling, it's sector rotation. So there's going to be some profit taking, and a bunch of growth stocks were down 5% at the beginning of July. And that's why I'm making the point. It's not going to go straight up. There's also another NASDAQ chart similar to the one you had with the compound. You said it's a rare thing. It made me think of it. There's a NASDAQ 100 chart that I put in there towards the end of it's basically data going back to 1985. I don't know if you
John, chart 11, please.
If you have it there. Yeah, this is similar to the one you were saying, which is this is data from 1985 to present. And it's similar to it's very rare because the one you had only happened 5 or 6 times. This is when the NASDAQ 100, after it goes from down 20% to a 1-year high within 3 months.
This means everybody was offsides.
Yes.
To being too bearish. We were wrong. But everybody bought.
Look at the times this has happened.
Bottoms.
It's come off of the 90-91 bear market. It came off of 98, off of the long-term capital. It technically wasn't a bear market, but it was a bear market in my view. From 2000 to 03, you had the dot-com, you had 9/11, you had pretty much a 36-month bear market. These are, after 2009, after the financial crisis. So my point is, after COVID, these are like major bear markets and scares in the markets. And this just happened on June 24th. And again, nothing's guaranteed. It's just rare. A year later, the Qs are up 40% on average. So it's pretty impressive.
Let's get into the Mag 7 and what might be the next batch. I've been sharing this chart with Josh for a while. We're talking about Apple divided by the S&P 500. And as far as I'm concerned, this ratio will never reach a new all-time high. Do you guys agree or disagree with that?
I agree.
Okay. Not only that, it is sitting at a very tenuous spot, multi-year support, and it just found support there again. I don't know if it holds for long or not, but Apple is probably not where you want to be if you are a growth investor.
Wall Street wants to see growth. Again, period, end of sentence. Wall Street wants to see growth. If the market's going up and you're growing your company, for the most part, your stock's going to go up. Is Apple going out of business? No, that's not what I'm saying. I'm just saying it gets to the point where it's just slow and steady, single digits, and go ahead if I mean to interrupt, but I just don't see any explosive growth from here.
So I'm going to say it flat out honesty about Apple. They're going to be here, but there is no world they're ever going to be a growth company again, ever. Yes, 2.4 billion devices out there. They should have been the leader of this ambient AI assistant trend that's going to be causing them to be this consumer AI winner.
Do you think if they buy one of those AI companies they've been talking about, would
would
that change your opinion, though?
Because this is the honest point that I was trying to get at. Talent doesn't want to work there. They have a culture problem. Big brains want to work at XAI. They want to work at Meta, Zuck. They want to work with Elon. They want to work at OpenAI with Sam. Nobody wants to work at Apple, this dinosaur of a company who they're comfortable being this cash cow. And their AirPod revenue is 4 times the revenue of OpenAI's top line revenue. They're comfortable just being a services company.
Is it can they change it or is it over?
It's over. I think you're seeing them try to wave the white flag without verbalizing it of we're going to have OpenAI and we're going to have Anthropic partner up with us and sell our real estate to them and make that cash, again, low-hanging fruit, but they couldn't solve it with in-house because they don't have the talent to do so.
It would have to be a major restructuring or
a
major acquisition that they could implement in to, what are you going to do? Take your revenues up another 3x from here? It's
so my tin hat.
The revenue's not growing.
No, it's not. It's a financial engineering company. That's all it is. But my tin hat theory is in 2-3 years, they're not going to be at the point that the board of directors want them to be. There is going to be a very splashy merger that I think that OpenAI's board is going to force upon potentially of an Apple OpenAI merger where Sam becomes the CEO of Apple. And that would be the tin hat theory that I have of, because I don't think Sam's going to go public.
But what about Microsoft? Why would they want that?
That's the only hurdle. I think I'm waiting for that sign of the OpenAI and Microsoft is having this weird conversation back and forth. I think that's going to be much more of a breakup than what we see right now. But I think that there's going to have to be a massive acquisition for Apple to get a product-oriented CEO to run that company right now because Tim Cook isn't product-oriented.
A few weeks ago, I showed Josh a chart of CapEx divided by revenue of, I think I was using Amazon, Microsoft, and Alphabet. And it was up and to the right. These companies are going all in. They are spending so much money, a percentage of their top line. I don't know if it's 30%. It's a huge number. Whereas Apple, it's going
R&D's lower.
Down and to the right. They're not doing anything.
So
they're not spending any money.
I mean, the natural derivative of what Apple should do is what's the next innovation of hardware? It's humanoids. That's what's going to be the North Star for Apple going forward. I haven't heard one thing about them trying to tackle that. Like, why not? You spend $10 billion on a car that just fizzled out and it was just a science project in the labs, but you're not willing to spend billions of dollars. Like, you're spending $600 billion on buying back stock. Just use 10% of that, $60 billion, towards some kind of avenue to conquer humanoids. Because I'm talking poorly about Apple, a Mac, Apple phone, AirPods. Like, they have leverage. Use that leverage to create what the future physical AI world is going to be.
Joe, when's the last time you owned Apple?
I don't remember.
It's been a while, huh?
I haven't owned it in a long, long time. I don't care to own it. I don't care to own it. I'm a growth manager. They're not growing. Period. End of
sentence. It's 30 times earnings. Like, it's not even.
It's
just not. It's not exciting to me.
Yeah.
You know?
All right. So, John, chart 15, please. What we're looking at are each individual Mag 7 stocks and their relative performance year to date versus the S&P 500. And what stands out to me very clearly is that it's NVIDIA, Microsoft, and Meta in one category that are winning, that are beating the index, that are getting the benefit of all of this growth that investors want. And then there's Apple down in the dumps, Tesla for a myriad of reasons not doing well, Google not great, and Amazon is sort of somewhere in the middle. Any opportunities of the companies that we just mentioned and the latter that are not in favor right now?
Tesla.
Why?
First off, I think Tesla and Apple are experiencing macro causes. Tesla EV solar credits removed. Apple had that China, like, you have to go away from China. So, like, there's a little nudge on that. But
so what's the bull case on Tesla?
Bull case on Tesla is, again, everyone's worried about the car delivery numbers we just got yesterday. 389 estimates, they came in at 384. Why did it catch a bid? Is because it wasn't as bad as feared. I think the lowest estimates were 350,000. They're not a car company anymore.
But you don't care about cars. I'm getting right.
So,
okay.
Yeah. So I think the future, like, why I'm bullish on Tesla, I own it still, top 10 position. They are the only player building the AI network for mobility and robotics. Physical AI is the greatest TAM in mankind history. It's the only one that could really replace. It can touch every part of the world and replace headcounts at a scale that's never been done before.
What does physical AI mean exactly?
Automation, like replicating a task that a human can do, essentially, in a non-digital form.
So actual robots.
Actual robots. And I think you're seeing all these videos of, like, oh, figures doing this, like lifting a string, putting it over here. They're a robotic leader. No, that's not how it works. General application of robotics is the only scalable approach. The only player to do that right now is Tesla. The timing is awful right now. Who knows how long this is going to take? It's going to be on the Elon Musk timeline. And what that means is you just never know, because he just is hyper bullish. But I think there's inevitability that Tesla is going to conquer humanoids. They're going to solve autonomy. It could be in 10 years. It could be in 5 years. But just think about how transformative autonomy would be in the car industry. Every car is being sold in your gross margins one time. Now, if autonomy is actually solved, your car can be your freaking employee. You can make an ROI on your car, buy it, and it drives other people. There's a application component of it where you capture that node in that vehicle sale, and then you can actually make an ROI on it. That's underpriced in the autonomy angle. It's going to take a while, but I think that's the North Star of Tesla. And I think it's going to hit. When it does, it's going to be so transformative that buying it under $2 trillion is going to be a deal. Because, again, caveats, how many companies right now that are early disruptors in the stock market are at the same price they were at 4 years ago? I can maybe do a couple.
I mean, the pushback is Tesla was, I mean, that was crazy.
That was crazy, but they're also going through a narrative change. Narrative change.
Yeah, that was a huge move that they went on.
Was it up 1,000% in 2020?
It was.
I think it was a 10 bagger.
It was up, 800 or something. Okay. Yeah. Because I remember Kathy Wood had a 10% position, went up 800%, and it was half of her gain that year.
So on the humanoid, is that like a hardware multiple though, or no?
No, it's as soon as here's an example. As soon as Elon solves humanoids, Amazon's going to buy thousands of them. All these companies are going to buy thousands of them because they don't care about solving the humanoids component because it's too CapEx, it's too complicated. They don't have the data feedback loop necessary to solve that issue. So as soon as they actually create that product, I'm just giving Amazon an example. McDonald's is going to use them. That's another example, but every warehouse will use them and it's going to be acquired. And that's why Amazon, for example, I'm a big Amazon bull, top 3 position. I think their retail presence is going to provide them such an enablement on capturing all these growth themes. Like, they don't care about creating their own drones or robots. as soon as there's a drone winner, they're just going to acquire all those drones, and it's going to be an immediate OpEx boom for them. Same with humanoids. As soon as Tesla sells the humanoids, it's going to be a major margin expansion opportunity in the retail side of the business because everyone has Amazon Prime. That's their moats. And they don't worry about investing to have everything in-house. They're just going to allow their retailer to enable them. But I think that a lot of people are going to wait in line to acquire these humanoids from Elon once they solve that. And who knows what the multiple is going to be on that, because it's going to be like an NVIDIA situation where their GPU is in such high demand that it's going to just cause them to have this 10-year boom probably that they're going to benefit off. And who knows what multiple is deserved when you have a 10-year supply and demand wonkiness and you're the only player in the shop.
You're going to do a podcast one day with two robots sitting across from you.
Maybe.
I'm telling you.
Joe, what names in this orb are you excited about? Like, how low in market cap do you go?
I can go low because, look, I agree with him that it's not just AI. I mean, even in the 90s, there wasn't just .coms. There was, fiber optics. There was cell phones, Ericsson, Nokia, all this. So there's other themes going on right now. So I do like that, energy, data center is technically, AI, but that there's huge growth there. And you have, again, people like Elon Musk and Larry Ellison, all these smart people saying like the demand, expected to go 1% to 8% of the energy grid for data centers and so forth. So energy is a theme. Space is a theme. You also have super smart people like Richard Branson and Musk and Bezos involved in space. Like, I think they're doing that for a reason. There's a lot but that's like 2027, 2028. So I'm okay with stuff outside of AI because there's just such sexy growth stories out there right now.
So when you think about the next Mag 7, are we thinking about names like CrowdStrike and Uber, or are you thinking like companies that like maybe aren't on our radar? Like, what's that flying plane one? Is it Joby?
Archer Aviation.
Archer and Joby are both in the flying taxis.
eVTOL, yeah.
Is that
planes.
real, or were we just smoking dust?
I think what's real about it is Anduril, the private company.
Yeah.
I think the defense component of like being above your head. I think the reason there's such an appetite for Archer Aviation is they're not just a hardware company. They have a software solution on top of that. It feels very much like a Palantir like components, and Anduril loves them. They pair up with each other all the time.
What do these flying companies do?
It could be something like I want to go to Brooklyn from here and just cuts through the traffic. It's going to be a much bigger like defense component where like the old defense has been hardware supremacy. That's a mentality for a lot of like what defense has been. Like the $1 trillion budget just last year has been towards like hardware dependency. The future is going to be a digital battlefield. And part of that component is, yes, cybersecurity. It's going to be a heavy component. Everyone's going to be attacking each other through that route. There's also going to be above your head, the drone component of it. There's going to be heavily vital for the Archer Aviation is a component of that. Another one is the Palantirs, the decision engine on identifying where the threats are. That's vital as well. So I think this digital battlefield is a massive theme that provides somewhat of a offensive and a defensive component, because during Q2, one of the strongest names in risk-on environment was these new age of defense names, the Palantirs, CrowdStrikes. It's because geopolitical tensions is somewhat of a tailwind for them, unfortunately. But if you also want exposure in AI and all these growth themes, you also have to invest in them. So they have the benefit of both worlds. And I do believe that it might be very early because Archer Aviation is a $5 billion company. It's expensive, but they're being used heavily in the 2028 Olympics in LA. Like, it's happening, the commercialization of that.
Do you think about the economics of these businesses, or is that like not to be disrespectful, is that a distraction
No,
to you?
it's not disrespectful. It's a real thing.
Are the economics a distraction, or are you just thinking about like that really is a distraction? I'm thinking about the explosive growth and the sort of like traditional valuation. It's just a sideshow at this point.
So I think valuation becomes part of the calculus based on the maturity of the company and how big it grows. Like Palantir, I could care less a little when it was under 25 billion. Now at 300 billion, first off, I haven't added in Palantir since the yen carry trade crisis when it hit $22. That was the last time I added. It's through the roof. I don't need to build a substantial position. But for Archer Aviation, it's all about their moat and advantage, especially in the future world we're about to enter, where this new age defense theme I'm talking about, eVTOLs is going to be a component of that.
What is?
eVTOLs.
What is that?
Essentially the flying electric vehicle flying jets above. So like the Joby Aviations, the Archer Aviations.
And they'll be electric, yeah.
So that's a heavy component
not
of it
just
as well,
the defense, but the retail for You need to go to Long Island and take you an hour and a half. It could
Yeah.
take you 20 minutes. Same, they're doing it in Dubai now. But that's the retail side. There's also the military component,
So,
the
all
defense
right,
component
do
as well.
do we genuinely think that there's going to be, because a lot of the talk has been about these incumbents, the hyperscalers. They are so big and powerful and virtually indestructible. They are the new venture capitalists. Whatever they see that's working, they just acquire. Is there going to be a company that gets to, I don't know, $2 trillion? That is, it could be on our radar or not. Like, is there going to be another Mag 7?
I mean, I think Palantir is the closest thing to that next Mag 7.
All right, what else? What are some
There's
other names?
always themes that, they rotate. It went from FANG and then people dropped Netflix because they didn't like it. And meanwhile, Netflix has been a monster.
Fine, let me ask
there's
a
always
question.
going to be.
Let me ask it better.
Yeah.
So the year is 2039. Are we still talking about Microsoft and Meta the same way we are today? If not, who is going to be in that sort of category? I know it's impossible.
No, I mean, I think whoever's
Don't say Palantir again.
Palantir. No, I think it's going to be whoever solves agentic AI at scale. I think whoever can figure out how to orchestrate outcomes at scale is going to be one of the biggest second wave winners of AI.
All right, so who's in that
No,
category?
I think
it's private companies though. They're all in experimental phase right now. That's why it's so tricky.
Yeah, and it's not just AI. I mean, I'm talking my book a little bit here with Rocket Lab.
Oh, I love Rocket Lab.
I mean, Rocket Lab, I wrote about it. I'm in from single digits. I wrote it publicly on my blog at $10. And if SpaceX just did their most recent funding round was $350 billion, and Rocket Lab's at like 10 to 15. I'm not saying it's going to grow to that point, but Barron's called them the closest competitor, even ahead of Boeing, the closest competitor to SpaceX. And that's the thing where that demand
Why didn't you tell me about the stock?
No, it's the
Thanks, Joe.
it's the
glad
FedEx
I
of
did.
space. I've been a big Rocket Lab fan under $5.
What a stock. Oh, my God.
No, it's because Peter Beck is
he's executing.
He's the Steve Jobs of the space era. Everyone thinks about Elon, but Peter Beck is a freaking scientist. Like, he knows how the rocket's built inside and out. He's all in on it. And they used to just be a satellite launching company or like a rocket launching company. They've morphed into a full-on space prime. They are becoming the space logistics company in the future.
What are they doing in space?
I mean,
They're
what
throwing rockets
aren't they doing
have
in space?
an Electron rocket where they've done, I think, 230 successful launches. Now their new Neutron rocket is going to compete with the Falcon 9, I believe, from SpaceX, meaning it can carry the bigger payloads, all this stuff for satellites. Again, I know. I'm
not trying to put you on the spot.
But I'm just saying, like, there is huge demand from companies, whether it's mostly, bringing satellites up there and all this stuff, basically through just not only companies, but from governments that need, and the, what do you call it? What's the word I'm looking for? The delay is like 12 to 24 months right now. So there are companies working on speeding that up. So that's the holy grail in space, is on-demand launching. Right now, if you call Rocket Lab or SpaceX, we'll get you in August of 2027. Like, that's the other thing, is there's huge potential for growth there.
All right, how about this? Let's flip this. What is overhyped garbage? What do we think is completely nonsensical?
If I want to really stick my neck out, I think Salesforce has not proven to me to be the disruptor.
Stop it.
No.
I'm talking about like companies that like are in the $10 billion category.
Oh, okay.
Like, let's go there. Like companies that are getting the benefit of the doubt. Because I was talking with Josh. There's a lot of bullshit out there, right? That's the feature of a bull market.
But this is what's great, is a lot of the companies we're talking about, Joby and Archer and Rocket Lab, these are highly shorted companies. Palantir, a friend of mine plays poker, and everyone at the poker game is short Palantir and CoreWeave. That's all they talk about. And I'm like, the Big Short just ruined these people, because they're like, they can't stop shorting them. So that's the whole thing, is the answer to your question is there's two sides to these trades, because some of the stocks we're talking about.
All right, you coward. I'll throw out some names.
No, I mean,
I'm just saying, a lot of people are saying, these stocks we're talking about are the ones that are not going to work out, but that's why we'll find out. There's two sides to these trades.
I do think CoreWeave might be the one name that's just bloated for capitalizing on the moment.
They have a $27 billion backlog right now.
No, that's the thing, but it's capitalizing on
from $30 million to almost $1 billion in sales in 7 quarters. It's insane. I mean, that's
Well,
I've never seen growth like
Why
that.
would you short that? Why would you short?
I wouldn't short it, but I think they're capitalizing on a moment right now where supply and demand is so offsides. And they're
It also could, with the float as well.
and they have one customer, essentially Microsoft. They have one supplier, NVIDIA, and they have one moment, which is right now they're capitalizing on. I think eventually supply and demand are going to even itself out. Who knows if you need a CoreWeave once that happens? That's the risk. I call him the broker of the compute era.
Business is booming.
But
For now.
sometimes
Exactly. You
things
never know,
shoot-
though.
Sometimes things shoot in advance of, the market
The market's
trades.
not dumb.
The market trades on what's going to happen, 6 to 12 months from now. And even with companies, their earnings top, 2 to 3 quarters. The stock tops 2 to 3 quarters before the earnings top. So Cisco topped in 2000 and they kept coming out with 50%. And everyone's like, why is the stock dropping? Because the market anticipates. It's smarter than us. It knows 2 to 3 quarters from now that stocks top 2 to 3 quarters before their earnings top.
All right, let me throw out two names that I know nothing about, like really and truly. So I'll ask you guys: Rigetti and Ionic, like names like that.
IonQ.
IonQ.
Quantum,
Is that how
quantum- there's a bunch of those quantum computing.
So
names,
is quantum computing real, or is that just riding the stupid bull market wave?
Didn't Jensen say it's like 10 years down the road?
He actually just changed it to 5 recently. He went from 15
He
to
went to
10 to
15 to
5.
10
But
to 5, yeah.
I think here's the issue with quantum. It's the only way to get captured to pure plays are very speculative names right now. So IonQ is, in my opinion, the most scalable approach to quantum because you can run their trapped ion technology in a room temperature environments. You don't have to go in sub-zero like the rest. But it's highly risky still because I think in order for quantum to reach ChatGPT moment, which I think Jensen's accurate, we're nowhere close to that. It's going to be essentially a science project that's going to be running at the expense of shareholders because right now what IonQ is worth $15 billion.
So you don't mess with like these.
Those
spec-
are-
I own
those are-
IonQ.
Those
Oh, you
are
do? Okay.
super
But
speculative.
I owned it when it was under $10. Now at $15 billion, I'm like, I don't know if the ChatGPT moment for quantum will happen by this end of this decade. There is some risk and reward issue there.
Nuclear is another one, super spec. And space, of course. I think space, quantum, and nuclear are all three super speculative. That doesn't mean they're not going to work out. They could be 10 baggers or they go to zero.
So Joe, I know you like to look at call buying. Why is that? Why is that a signal?
A lot of big institutions will, sometimes getting into 300,000 shares, 1 million shares, whatever, just doing that on the open market it's you don't want to show your hand and, all that stuff. So a lot of big institutions will get into positions through options. That's why I like to keep track of the big option trades. Like Carl Icahn, when he got into that Netflix position, it was all through options. He bought in the money calls.
Oh.
Bill Ackman's done the same thing. Even when you've seen some of these activist investors that, Nelson Peltz and some of these things, they get into them starboard through. You'll see blocks of 2,000, 5,000 in the money calls because then once they exercise, they just get assigned those shares. They don't have to really buy them on the open market. So I like to follow what they're doing. And for the past 2 or 3 months, it's been, I even have the list here, Amazon, Google, ARM, NVIDIA, Tesla, Avago, now Palantir, even like ARM Holdings, they're buying just go look at the open interest of June 2027 calls. Like it's insane. They're buying like 10 million every day. So I'm not saying it's going to work out. I think these are big institutions that are playing for, and I wrote that in my piece, June of 2027, December of 2027, they're putting the huge footprints into these stocks. And who knows if this ends up surpassing what the average person could expect, these could end up being, if they're all going to go up because of their weighting on the averages, then the averages are going to go up as well.
John, can we throw up chart 16? Shay, tell us about Futurum AI 15. What are we looking at here?
Yeah. So again, I referenced that the biggest winners of the dot-com era wasn't just the first stage, like structural arteries. It was the second stage. This is who we believe will be the second stage winners of AI. So you have the control layer, which again, AMD, I love that they're catching a bid right now because a lot of people had the complete wrong narrative on AMD. Like everyone's like, oh, they have an NVIDIA problem. Like, are you kidding me? The AI acceleration market is going to be $500 billion in the next 3 years. NVIDIA will capture 80% of that. So they have $400 billion of that. What's the remaining? All AMD has to do is capture a sub 10% share, and that's $50 billion right there. That's substantial. So I think AMD is going to be using inference and as the massive tailwind for them to capture that sub 10% share. And if you don't know what inference is, I mentioned that AI's intelligence. Let's just call it inference the tax on intelligence. So as much as you use, that's why once training data goes lower and lower, inference will explode because it's going to be a lot more affordable to have these AI experiments. Another metaphor you want to use is cars. Like during the DeepSeek pullback, training data was going to go lower and it took everyone down with it because they're correlating training data and AI, when that's not the case. So if training data is like gas becomes cheaper, do you think there's going to be more or less cars on the road? There's going to be more cars on the road because going from point A to point B is going to be much more affordable. Same thing happens in AI. So as training data gets lower and lower, inference will explode. And that's where you're seeing AMD be a major beneficiary of that. Seeing Micron with memory being a beneficiary of that. The biggest beneficiary of that is actually Broadcom, their networking component. Every hyperscaler we've talked about uses Broadcom. I think Broadcom is actually going to be a top 10 company for the next like 5 to 7 years, maintain that status. A lot of people talk about NVIDIA, TSM.
Yeah, that's a forgotten trillion market cap that people don't talk
Broadcom
about as much.
They're Uncle Sam. I call them Uncle Sam because remember that reference I made tax on AI? They are legitimately Uncle Sam. So the more people use AI workloads, they're going to benefit on the inference angle on that. So that's a control layer, like the first layer of like they're going to benefit from inference. The operating layer is what we're talking about for the software component. Everyone's talking about Palantir. I'm not going to get into that. We have ServiceNow. They're the IT management go-to. Bill is got his finger on the pulse on where the puck's heading. I have full confidence that
Bill Cosby,
Bill McDermott.
Okay.
But Oracle, for example, databases. Everyone talks about, Oracle was like a dead company, 7 years ago. It was not going anywhere. This was the second win that caused the renaissance for them because all this data is going from left brain to right brain constantly. What do you have to do with that data? You have to have governance in place to make sure it handles it correctly. Nobody can do that besides Oracle. Their presence is unmatched. And you're seeing their OCI just continue to drive this company to new highs.
What's the story with IBM? We were talking about the stock earlier.
I know.
My God. It's gotten a second wind.
20th. Some of these old tech names, and you know better than I do, they've just reinvented themselves, or they're getting more into either services or the software layer that is helping margins as well.
Well, they're so essential in the enterprise space that as soon as there's a revolutionary movement like AI, you're going to have to go through them. You can't take them out of your ecosystem. So that's why you're seeing the IBMs, Oracle, Cisco. Like we just talked about Cisco and it's at all-time highs now.
Yeah.
Wow.
So it's like they're all experiencing a renaissance, but Grandpa's favorite picks are doing really well, but also the kids' picks, CrowdStrike, Cloudflare, Palantir, ServiceNow, they're also doing really well as well.
Everyone's happy. Grandpa and the kids.
All right. Maybe a good way to end this conversation is Jeremy Grantham's quarterly letter from 2017. Joe, why are we talking about this?
I thought it was fascinating because, and your interview with him was awesome, by the way.
Thank
I know
you.
when he was on. I just, from a value manager, because I'm not just the stubborn, only want to listen to growth people. I love listening to value people, whether it's Bill Miller, Grantham. People are, again, super smart.
They have a little bit of a more sober view.
Yeah,
than, say,
because
Shay
I
does.
want to hear the other side, and he basically was making the point when I'm paraphrasing his letter. It just really resonated with me 10 years ago, is that when he got into the game and studied Benjamin Graham and all this stuff, the average PE of the S&P was around 13 and some or so, and it always kept reverting to the mean. But then if he stubbornly stuck with that, he would have ruined his entire career, because one of those slides shows that I think it was pre-19, I don't know.
John, chart 21, please, or 20.
97, I think it was.
Are you talking about margins?
No, the one before that, the average PE of the S&P. It's the first one.
Okay. John, chart 19.
It's the first one on the list there.
Yeah, so talk through it, Joe.
Yeah. Basically, he's saying that if he just, if he went with what was historical, it would have ruined his whole career.
So pre-1997, the average PE was 14.
Yeah.
And if that was all you knew, and then you saw all of a sudden stocks are trading at 20 times, and now the average 1996 to today is 24 times,
Yeah.
you would have been left in the dust.
That's exactly his point. So when Paul Tudor Jones says you have to adapt, evolve, or die, I think the key word is adapt. And what I love about what Grantham did is he's like, look, if I was stubborn and only went with pre-1997 average PE, and it always reverted back to that line, when it got below that, it was great value. When it got above that, well, something changed. So from 96, 97 afterwards, you're used to the PE being 14, it goes to almost 24. That's a substantial change.
Well, here's what changed. John, next chart, please.
And what changed was profit margins.
Why did profit margin?
One of the things he talks about, and this is an example with the Shiller PE and the equilibrium. The next one, though, is profit margins, is that corporations got more efficient. Technology. Things, again, productivity. So profit margins was part of the reason. He also gets into interest rates as well and leverage and birth rates. It's a pretty deep piece, but the next slide on profit margins shows that we can justify that PEs are going to be higher because the profit margins are better. So you're going to get what you pay for. But this is what I'm getting at, is that we might have this conversation 10 years from now, and the average PE of the S&P could be 30 for the next 10 years. And someone will say, that is ridiculous. That's insane. That's not what I studied in my business school, and my MBA says otherwise. But Grantham could have done the same thing. If you told him a long time ago the PE was going to go from 14 to 25, he would have said that's ridiculous. Well, you could see it go higher.
So you absolutely could. Investing, the way that it was taught to the Grantham's generation, is that we are investing not just in pieces of paper, we are actually investing in companies. And you have to look at the ratios, because this is shorthand for, if I'm buying the business, just flip the PE. It's an earnings yield. You have to earn some reasonable rate of return on your investment.
Agree.
The thing that nobody could have foreseen going forward was that the yield today of 3 was going to grow to 5 to 6 to 7, because the earnings growth is so explosive, and the margins are sustainable and defensible. And not only that, they were accelerating. And so technology has had a high bar for the last 10 years. FANG was coined in 2017? Like, it had been hot, but the bar just kept getting raised, and they kept going over it and over it and over it. And where does it end? Obviously, who knows?
I'm saying you have to be open-minded.
You have to be open-minded
to change. You have to be able to adapt, because if Grantham didn't adapt, he's like, I would have been smoked, and he's viewed as one of the best value investors. In fact, one of the best investors ever. And I'm saying that it's not going to happen, because someone's going to listen to this who's an old school value person saying, you're saying the PE of the S&P is going to be at 28 or 30 for the next 10 years. I'm not saying it's going to. I'm saying if it does, don't sit there and fight the tape and fight the market. You have to be able to be open-minded.
So, Joe, when this bull market ends, I was about to say if and when, because it will end eventually.
I'll be crying under my bed.
And it might be in 27 or 28 or 34 or who the knows.
Right.
I know you will know what to do. Now, I'm not saying that you're going to call the top, but you will see the change in character. You will see the distribution. You will see earnings declining and stocks falling suit. And
leaders
eventually,
breaking down,
you will protect
all
yourself.
of that stuff. Yeah.
What are you going to do? And, and how are you going to know when we are approaching, and I know nobody can act, but how are you going to know when we're like, all right, this is getting stupid?
That's a great question. First off, I think there's going to be multiple derivatives of AI. I think he mentioned it earlier on the show, where like right now it's just enterprise AI. There's going to be a physical AI. There's going to be agentic AI. There's going to be so many different derivatives that if this hot pocket is looking inflated, there's going to be a next pocket that's really being underappreciated, because nobody knows the timing of that transition. So I think an example is like, if things get inflated, like let's just say it's 2030 and it's over 30 times earnings, and a lot of these companies, all my holdings are like a Palantir, for example. What am I going to do? I'm probably going to start becoming a little defensive with some maturity names. Like, I'm going to be buying the Googles out there, the Amazons.
You're going to buy Apple.
Do you sell some if the position gets too big of the portfolio?
I never sell.
But you know what? You're a young man. Like that's
right. But
okay.
I also have a healthy DCA plan. So like right now, I haven't bought in 6 weeks. I love to buy when the blood is in the water. Like, I love it when it's red.
DCA with your stocks or with indexes?
With my portfolio of stocks.
Okay.
So like, I think when there's max FUD, like when there's VIX at a 50 handle, I'd never like to have cash. I'm getting in, because I'm very confident in these themes long term. There are structural shifts, but I know I'm underscoring a digestion period that's going to be multi-years. I don't think there's going to be like a 2022 pullback of 70, 60%.
That was gnarly.
I think there's going to be a dead 5 years. I think there's going to be a digestion period to let the multiples catch up to the stock price. And I think during that digestion period is where you can really capitalize on maybe some other hot pockets that weren't getting the attention right now, like space.
Or the winners might separate themselves.
Yeah, winners and pretenders. But like,
Joe, do you think that this could end in a digestion period? Doesn't it have to end in a boom and a bust, or not necessarily?
It usually does, with where you just get an acceleration period, and your neighbor and the mailman and your neighbor's dog and everyone's making money.
We're not there.
I don't think we're there yet because, again, I'm not going by one poker game that my friend plays in, but when they're all like,
Well, there is one poker game.
when they're all shorting everything, when institutions are like, I don't like this, I'm not, and they're reluctant to get back in, and when everyone's like bubble, 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 you know, that whole line is a bubble's an asset class that goes up that you don't own, because no one's saying it's a bubble if you own it. It's people. So it can go on again. Moves can go on much longer than we can expect. And if you do see a period where in 99, the Qs were up 92%, the NASDAQ 100 was up, that's an index. The average stock doubled. If something like that happens, then I'll be here telling you got to take profits. Yeah. If you don't, then you're going to see it, because I don't want people, if we do see an accelerated bull market that's really starts to accelerate, you know, as I say, you got to ring the register, take some profits along the way, because otherwise you're going to ride it all the way up and ride it all the way down. Yeah. So you have to be able to manage risk if you're trading individual stocks.
All right, Joe, you were phenomenal as always. Shay, excellent appearance as a first timer.
I learned a lot. Thanks for
appreciate having me.
It's awesome.
Okay, before we let you guys go, what are we looking forward to for the summer? It's July 4th weekend. What do you got any good plans? Anything you're excited about?
Flying back to LA tonight. Probably going to Newport Beach. That's usually the scene. My fiance's friends has a boat there. Might be doing that.
Nice. Are you from LA?
Angelino.
Yeah.
My whole life. Yeah. So going to be doing that and taking advantage of the time off, because gotta say, I did 6 TV comparisons this week.
Good for you.
It's freaking disgusting in New York out. Like,
It's
oh my
gross.
God. I had
It's
an Uber
gross.
0.4 miles away because I didn't trust my sweat right now. Like, I was like, I felt awful requesting Uber, but that's
Yeah,
just
you
how
gotta do what you-
I
Joe?
did.
Humble brag, Andre Agassi agreed to do my podcast.
Get the how?
What?
Yeah.
Wow.
I ran into him, and
Legend.
long story short, my friend, she pushed me. I'm like, I'm so nervous. He's a tennis icon. He was sitting there playing slots in Vegas. He's from Vegas. He grew
Joe
up there.
Joe is very humble and modest, but I will say this. You are one of these weirdly connected people. I don't know how you do it.
I don't know either. This is one I don't know. I've never met him. He's born and raised in Vegas. My friend.
But you know what it is? I think you're very non-threatening. Like,
so I told Josh the story, and he really made a funny point. I asked him, I just said, look, my friend, she pushed me to go say hi. I just said, I'm a big fan, and I appreciate what you do for the community. He's given millions of dollars to schools and everything. And then I was like, well, while I'm here, I'm like, do you want to do my podcast? And Josh goes, you just went from, I don't want to bother you, to, can I have 2 hours of your time? And he said, look, I have other friends I have to do, but if you're local and, you know, you have a studio here, I support you. And because that's where I record, where you've been kind enough to do my podcast, and I got to get you on as well. But he's like, I'll do it later in the fall. I have to do some others because I have to do theirs before yours. And he did Andy Roddick's podcast just a couple weeks ago.
holy shit, unbelievable.
So anyways, something to look forward to.
Joe, how do people find you on the interwebs?
JoeFahmy.com, @JFahmy. And the podcast is Joe's Happy Hour on YouTube, Spotify, Apple Podcasts.
All right, Shay, you're blowing up. Where do people find you?
Stock Savvy Shy on X, but also
Wait, say that one more time?
Stock Savvy Shy.
Stock Savvy Shy. Okay. I've been calling you Shay this whole time?
It's all good.
Okay. Where else?
FuturumEquities.com. Like, that's a new new research firm that we're starting, the democratization of research for everyone. So follow the Twitter account, go on the website. We will launch a lot of Futurum AI 15 lists. We're going to launch those lists every single month.
Listen, your enthusiasm is palpable. I love to see it. So congrats on all your success so far.
Thank you.
Awesome.
All right, that is it for us. Thank you, Duncan, John, for keeping you late on a Thursday afternoon. Am I the worst? You guys thought you were getting off this week, didn't you? Okay. Nicole, Daniel, the whole crew, thank you for watching. We will see you next time.